We know the Canadian ETF market had a massive year last year, record-setting growth. Let's get more from Valerie Grimba, Director of Global ETF Strategy at RBC Capital Markets. Valerie, thank you very much indeed for joining us. You have some interesting observations here. One is that we're into an era where so-called digital natives are investing. These are younger people, not all of them young, some in their 30s, who've essentially been on the internet their whole life. What effect is that having on the ETF market?
Absolutely. This segment has really been creating and shifting trends in the ETF market really since the pandemic, since 2020, but even more so in 2025. And what we're seeing is the rise of education, investment content coming to market through these digital channels. And then the ETF vehicle is there for this type of investor to pursue those investment strategies in different ways, and using the ETF really to provide different types of access that they might not have had before or without an ETF to do that.
ETFs are getting more complex, and in some cases they're getting racier, aren't they? Using leverage to produce, in theory, big returns from day to day.
Yeah, exactly. And I think this gift, this choice, this extra choice for investors is a gift, but there is an amount of due diligence that needs to go alongside this increased sophistication. Listen, again, this is about the ETF as an access tool, as a vehicle to kind of democratize investment access. So we have strategies like CLOs, which before were the domain of institutional investors. We are going to see the continued rollout of structured products embedded within an ETF, and previously structured products were the domain of advisors. So again, it's about providing these different tactical tools and using really the ETF to give those tactical tools to investors that might not have had access to these investment strategies prior. So I think it's just a great thing, and it's really exciting time to see this innovation in the industry.
We learn something new every day. Apparently, there's a thing out there called auto-callables, and they've been wrapped into an ETF structure. What are auto-callables?
Andy, that's the million-dollar question, and we probably won't have enough time to get into it today. But the gist, we can get into the gist. It is a series of structured notes that have this auto-callable feature where they can get called. But at the end of the day, the auto-callable is a strategy that is designed to provide additional incremental yield to the investor. There is, obviously in finance, a risk-reward picture that goes along with setting up the mechanism that provides that additional payout to the end investor. But if it does sound intriguing and these products are really taking off in the US, I would suggest an investor to do some research, watch some videos. Again, there is a lot of content out there in the world right now, which is absolutely wonderful. But buying an auto-callable product does require some investment knowledge and understanding what you're buying there.
Of course, the idea originally with ETFs was they just hold an entire index. Canada invented them with the famous XIU that would just track the TSX blue chip stocks. But active management has become the flavor of the past few years.
Yes, and I think this just kind of shows the versatility of the ETF vehicle. Listen, the passive ETFs, the kind of S&P 500 ETFs, the TSX Composite, these are going to still be the biggest and kind of the bread and butter of portfolio building blocks. But active management within an ETF has really been the story of 2025, and I think these trends will continue into 2026 as well, and we will see continued growth in the active side of the ETF world. And really what's driving this is a handful of things, but really we're seeing ETF issuers or even asset managers in general seeing ETFs as the preferred vehicle of choice for investors, and they want to provide that best-in-class active management where they're promising outperformance and alpha generation and giving that kind of to the masses in the shape of an ETF. And so just to give an idea of how much they're punching above their weight, active ETF assets are less than 10%, but they saw nearly a third of all ETF fund flows in 2025. So it's clear that this segment has a lot of momentum, and I think this will carry through till 2026 as well.
That's amazing. So only about 10% of the existing universe is active ETFs, but a third of the flows. Yeah, that really does speak volumes. We have this obsession with yield. We've seen obviously one very popular category, these covered calls. Do you think there's any risk, though, investors understand that they may be giving up something with these covered call ETFs that give them a big yield?
Yeah, absolutely. It's just about making sure the investor understands what they're buying. They're neither inherently good nor bad. It's just a series of trade-offs, like all things and most things in finance, and you need to understand what you're trading off. So if you like the idea of consistent yield, if 10% yield is kind of what you're chasing for this part of your portfolio, then absolutely a covered call solution can make a lot of sense. But if you are, at the end of the day, just want kind of to optimize capital gains, then you might underperform just investing strictly in the underlying on its own. So again, trade-offs and understanding those trade-offs. But here in Canada, we've seen these ETFs really take off, and especially the ones that add a little bit of leverage, a quarter turn of leverage, to kind of again enhance those returns.
What about the trading of ETFs? Are they always liquid, or do they? I mean, I know they're designed not to go to a big discount because people will use arbitrage to create or destroy them. But is the trading liquidity all it could be?
Yes. I mean, and that's our job of market makers, is to step in and provide two-sided markets. But we're calling this the complexity conundrum. So it's great, we talked about it earlier, to get these more complex strategies within an ETF wrapper, but there is usually kind of wider spreads and maybe potentially higher trading costs. And again, that's not necessarily a bad thing. It's just something to be aware of. But really, I don't think liquidity in the ETF world has been a problem, and ETFs have really stepped up. You know, even saw through April of last year and Liberation Day and tariffs that ETFs provided that liquidity. They became that release valve for the market. And so we've seen, you know, the market really price things effectively and have no problem to kind of providing that intraday liquidity that ETFs are known for.
Valerie, thank you very much indeed.
Thank you, Andy.
Valerie Grimba, Director of Global ETF Strategy at RBC.